In January 2008, a junior trader at a French bank was sitting at his desk, staring at a number so large it didn't feel real. 50 billion euros. More than the entire bank was worth. And nobody, not his bosses, not the risk department, not the board officially knew it existed. His name was Jérôme Kerviel. He never stole a single euro, and somehow that makes the whole story worse. Brive-la-Gaillarde is not the kind of place that produces Paris bankers. It's a small city in the French countryside where your father works with his hands and your mother cuts hair. That's exactly where Jérôme Kerviel grew up. Not born into money, not connected, just smart, disciplined, and burning with something most people in finance recognize instantly: the desperate need to prove himself. In the year 2000, he earned his finance degree from the University of Lyon, respectable but not the elite schools that produced most of his colleagues at Société Générale, France's second-largest bank. They gave him a job and put him exactly where outsiders go: the back office. The traders upstairs called it the mine. It was the unglamorous machinery of banking, processing trades, reconciling numbers, keeping the system running. The real traders barely acknowledged the people down there. But Kerviel paid attention to everything. For 5 years, he studied the bank's entire internal architecture. Every risk control system, every automated alert, every gap. He wasn't just doing his job. He was, without knowing it yet, building a map. In 2005, he finally made it to the trading floor, the Delta One desk. It sounds impressive. It isn't. Delta One is designed for tiny, boring arbitrage trades, buying and selling nearly identical financial instruments on different exchanges to capture small price differences. Razor-thin margins. Zero excitement. Kerviel, who had spent 5 years dreaming about this moment, was now doing the financial equivalent of counting pennies. But then he started making real bets, directional bets, actual gambles on whether European stock markets would go up or down. And at first he was right, massively right. By the end of 2007, his hidden positions had generated 1.4 billion euros in unreported profits, from a desk that was never supposed to gamble at all. At that point, he had two choices: confess and probably lose everything, or keep going. He kept going. Here's how the trick worked. Every time Kerviel made an unauthorized bet, the bank's risk systems automatically looked for an offsetting trade, evidence that his position was balanced and hedged. So Kerviel created fake ones. Fictitious trades entered directly into the system, designed to cancel out his real ones. From the outside, his book looked perfectly safe. He could build this illusion because he'd spent 5 years in the back office, learning exactly which systems checked what, and which ones didn't check at all. The bank's automated controls sent 75 separate alerts about his account. 75 times a computer flagged something suspicious, and 75 times someone cleared the alert without looking deeper. Why? Because the positions were making money. In finance, when a desk is printing profits, nobody asks uncomfortable questions. The unspoken rule isn't, "Is this right?" It's, "Is this working?" And Kerviel was working. So the bets grew. 1 billion became 10 billion. 10 became 20. By January 2008, his total exposure had reached 50 billion euros. That single position was larger than the entire market value of Societe Générale itself. One man, one screen. One bet bigger than the whole bank. He wasn't operating from a hidden server. He was sitting at a normal desk in a normal open-plan office, surrounded by colleagues who had no idea. The scale of what he was hiding was so enormous that nobody considered it possible. Which was, of course, exactly why it worked. And then the markets turned. Late 2007. The American housing market is collapsing. European stock markets start wobbling. Kerviel's 1.4 billion in profits begins to evaporate. He doubles down. The positions grow larger. The markets don't reverse. 75 alerts. All cleared. But on January 18, 2008, one specific anomaly surfaced that a compliance officer couldn't easily dismiss. A small discrepancy in a counterparty confirmation. Enough to trigger a weekend investigation. 20 people worked through the weekend. By Sunday night, they had the full picture. 50 billion euros, hidden inside one of France's most respected financial institutions, disguised by fictitious hedges, undetected for years, not because the controls didn't exist, but because when the position was profitable, nobody wanted to ask. Here's what should bother anyone who has money in any financial institution. None of this required hacking, outside accomplices, or criminal genius. It just required someone who understood the gaps and a culture so focused on returns that raising questions felt like a threat. Monday, January 21st, 2008. The bank begins unwinding Kerviel's positions. 3 days, 50 billion euros sold into a market already in freefall. That week, global stock markets posted their worst single-day losses since September 2001. Several economists later argued that Société Générale's forced selling helped push global markets deeper into crisis. The bank disputed this. The markets did not care. Final damage, 4.9 billion euros. Gone in 72 hours. Chief Executive Daniel Boutin resigned. Kerviel was arrested. In 2010, a French court found him guilty of breach of trust, forgery, and unauthorized computer use. 3 years in prison, and a restitution order of 4.9 billion euros against a man who owned essentially nothing. He served 5 months. The bank was separately fined 4 million euros for failing to act on its own alerts. 4 million. For a 4.9 billion failure, Kerviel has maintained ever since that management knew that when the profits looked strong, nobody wanted to ask how. The courts rejected that argument, but the 75 unanswered alerts remain in the public record, and they don't disappear. So what do you actually take from this? First, profitable is not the same as safe. This is possibly the most dangerous confusion in all of investing. Societe Generale's own systems triggered 75 alerts, and every single one was dismissed because the returns looked good. The moment you stop questioning performance because the numbers are strong, you have turned your risk management into decoration. Second, know who controls the controls. Kerviel wasn't a hacker. He was a former back-office employee who understood the system from the inside. The most dangerous person in any organization is the one who knows the rules well enough to work around them invisibly. When deciding where to put your money, ask who approves the trades and who records them. If it's the same team, that's a gap waiting to be exploited. Third, size does not equal safety. Every investor in Société Générale believed they were in a well-managed, diversified institution, and on paper they were right. But concentrated risk can hide inside structures that look completely solid. When evaluating any financial firm, go beyond the headline returns. Look at real stress tests, risk disclosures, actual loss history. A flat profile with occasional extreme outliers is a red flag, not a clean record. And fourth, this one is for anyone building a company. Organizations that punish honest reporting of problems are building their own time bombs. Kerviel couldn't stop because stopping meant confessing. The culture rewarded profit and penalized failure so aggressively that hiding the truth became the rational move. The first person to raise a red flag should be protected, not removed. Because the cost of ignoring a warning is always, always higher than the cost of acting on it. One man, one desk, 50 billion euros hidden in plain sight, and the institution that missed it 75 times paid a fine worth roughly 0.08% of the total damage. Justice, like arbitrage, depends entirely on what you're measuring. The next fraud is already happening. The alerts are being cleared. Someone who knows the system just a little too well is watching a screen somewhere. Subscribe to Capital Sins so you see it before the collapse. And click the video on your screen right now. The next case involves the same blind spots at global scale, and it took the entire world economy down with it.